So, let's kick things off today with a bit of a paradox. One that actually catches a surprising number of entrepreneurs totally off guard. Imagine a business with millions in reported profit, celebrated by its founders and investors. Now imagine that exact same business just weeks later, permanently shutting its doors because it went bankrupt. How is that even mathematically possible? Can a business that looks incredibly profitable on paper actually go completely broke?
Welcome to this explainer. Today, we're putting on our financial detective hats to uncover the real story hiding behind a company's numbers. We're going to look way past the surface level headlines and dig into the actual mechanics of how cash, profit, and financial health really work together.
Here's our case file for today. First, we'll run through the 3 phases of profit. Then, we'll untangle the profit illusion by separating cash from profit. After that, we'll compare absolute profit versus profitability, dive into a live retail case study with far more cycles, and finally, hash out the long-term sustainability debate. All right, part 1, the 3 faces of profit. Let's understand the layers. Because, profit isn't just one magic number on a spreadsheet. Think of total revenue, the money coming in from all your sales, as the starting point. From that giant bucket, we have to siphon off different costs in 3 distinct cascading steps to see what the business actually gets to keep. Step 1 is gross profit. The math here is pretty straightforward, right? It's just revenue minus your cost of sales. This is the money you make purely from your core business activities, way before we even think about office overheads, administrative costs, or marketing. So if you're selling a bike, this is just the sticker price minus what it costs to physically build or buy that specific bike. It basically tells us, hey, is your fundamental product actually viable? Moving down the income statement, we hit operating profit. Here, we take that gross profit and subtract your operating expenses. We're talking about the day-to-day grind, rent for your shop, salaries for your staff, insurance, marketing campaigns. This one is absolutely crucial because it reveals the core health of your business operations before the bank or the tax man ever gets involved. And finally, we hit profit for the year, the ultimate bottom line. To find this, we take our operating profit, add in any random extra income, and then strip out the net finance costs like loan interest, and, of course, taxes. When all the dust settles, this is the absolute final amount of cash. Actually, let me rephrase that. It's the final value a business gets to claim after literally every expense is accounted for. Which brings us to part 2, the profit illusion, and the terrifying reality of liquidity crises. Okay, this is where things get really interesting, and we absolutely have to distinguish between profit and cash. Profit is, at its core, a theoretical accounting concept. It's what is left on a piece of paper over a specific period of time. Cash, though, cash is the physical, hard, liquid currency sitting in your bank account right this very second, ready to pay the bills. And this completely explains our opening paradox, how a profitable business goes belly up. You might land a massive whale of a client and your reported profit shoots to the moon. But if you have high receivables, say you give them 90 days to actually pay that invoice, you literally have 0 cash from that sale in the meantime. Or maybe your cash is trapped in a warehouse, literally piled high with unsold inventory. A great metric to check here is the current ratio, which measures your short-term assets against your short-term liabilities. If your ratio is, say, 0.74, it means you only have 74 cents on hand for every single dollar you owe right now. You might look incredibly rich on paper, but if you can't pay your suppliers today, it's game over. All right, let's move to section 3, profit versus profitability, and the metrics that actually matter. Let's try a quick thought experiment. If a massive tech brand makes $330 million in Region B and only $168 million in Region A, Region B is the obvious winner, right? I mean, it's nearly double the money. Well, hold on a second. We're missing the whole picture. Let's look under the hood. Yes, Region B made $330 million, but it took a whopping $3 billion of initial investment just to set it up. Region A only made $168 million, but it only cost $1.2 billion to get off the ground. If we calculate the return on investment, or ROI, Region A is actually kicking out a 14% return, while Region B is lagging behind at 11%. So while profit is that raw dollar amount, profitability is totally relative. It tells you how efficiently a company uses its resources. In this scenario, Region A is hands down the more profitable investment because it works harder for every dollar you put into it. Let's put this into practice in Section 4, Case Study, far more cycles, and the brutal reality of retail competitiveness.
So let's look at Far More Cycles. They are an independent bike shop that's really feeling the heat from big national chains. Why? Well, it all comes down to buying power. The big guys buy in massive bulk, riding the wave of economies of scale to push their unit costs way, way down. Far More, being a small local shop, just doesn't have that kind of leverage, so their raw unit costs are significantly higher right out of the gate. To really diagnose what's going wrong at Far More, we need to look at their profit margins. Margins translate those raw profit numbers into percentages, which shows us exactly how many cents on every pound of revenue actually turn into profit. The math is simple. Just divide profit by revenue and multiply by 100. So if you sell a bike for £1,000 and your operating profit is 150, bam, that's a 15% operating margin. The national chains naturally command much higher margins, largely because they can spread out specialist costs, like a massive corporate marketing team, across hundreds of different stores. Far More definitely doesn't have that luxury. Let's say they try to run their own digital ads without any real in-house expertise, and they end up paying an insane £7.80 pay-per-click rate. Even if they have a decent gross profit markup on the actual bikes, these sky-high operating expenses will absolutely crater their operating profit margin. They're essentially burning cash just to get people through the front door. Which leads us perfectly into Section 5, the sustainability debate, cost-cutting versus prices. When you really boil it down, a business has two main levers it can pull to fix its margins. You can either ruthlessly slash your operating costs, or you can hike up your selling prices. Let's look at the extreme ends of both strategies to see what is actually sustainable in the real world. On one side, we have the relentless cost-cutting approach. Think of fast fashion juggernauts like Shein. They are absolute masters of lean production. They rely heavily on Kaizen, this philosophy of continuous, tiny improvements to aggressively eliminate waste. Couple that with just-in-time inventory, where they hold practically zero stock to avoid warehousing costs, and they can offer mind-bogglingly low prices. But, and it's a huge but, the risk is massive. Operating with zero buffer stock means that if a trend explodes overnight or a shipping container gets delayed, they instantly stock out. And in that industry, if you're out of stock, your customer is already shopping somewhere else. Now, flip the script and look at the revenue-increasing strategy. Classic Apple. Instead of cutting costs to the bone, they pour billions into brand reputation, premium quality, and tech supremacy. They're aiming for what we call price inelastic demand. In plain English, they want customers who will buy the new phone regardless of whether the price goes up. Because people perceive so much value and trust the brand, Apple can widen those profit margins effortlessly. The catch here is obvious, though. Premium pricing automatically alienates highly price-sensitive shoppers. So as we close out today's case file, I want to leave you with a question to chew on for your own ventures, or just to ponder the next time you're out shopping. Is it a safer long-term bet to ruthlessly hunt down every penny and cut costs, knowing one supply chain hiccup could spell disaster? Or is it smarter to play the long game, investing heavily to build a premium brand that commands higher prices, even if it shrinks your total market? Which path to profitability do you think is actually built to last? Thanks for tuning into this explainer, and I'll catch you next time for another deep dive.